Let's move on to another very popular strategy, which is simply long calls and long puts. Let's use something like Morgan Stanley.
Long calls. Now, if it's a pure binary play for earnings, there's no there's no statistical difference with which expiration you choose. If it's a long call position and you are buying it for an earnings move, like Tony just talked about, it doesn't matter whether you buy July, August, or September, because for dollars at risk, the risk is essentially priced perfectly across multiple months. So what really matters is what call do you buy? And remember, Tony's question was not whether or not you're buying a spread, it's which call do you buy. Now, I think the important thing to look at here is you need to know what the expected move is. Because what Tony mentioned, stock closed at 104.65. And Tony mentioned that he thought the stock could go to 109. The expected move is actually in August is $4.50, which takes you right up to 109. Assuming that you're right, takes you right up to 109. So the question is, where, if it did August, keeping everything consistent with the Apple trade, at what price do you get the most bang for your buck with respect to both risk and, where do you want to go, and what option do you want to buy so that you're not, potentially not buying too much extrinsic. And I think in this case, because if the expectation is that it goes to, expected move, which is kind of best case or higher than expected move, obviously, that's just the best case. I would go to the at the money. So I'm buying the 105 calls for 287 in this case. And I'm hoping that if that move happens and there's still, you said the earnings are next week. Okay. So you're still going to have,
Yeah,
almost 30
next week.
days of you're going to have almost 30 days of premium left in this trade. If it does get up to 109, then these calls are going to be trading somewhere in the neighborhood of about 4.5 or so. It's not going to be quite a double, but it's going to be a decent trade. Now, if you wanted to buy the 110s, those calls would also just about double if the stock went up to about 109, just based on the way these pricing is. But I don't like buying just pure out of the money extrinsic outside of the expected move. So for me, Tony, I'm probably buying the 105 calls. Now, some people are going to say they like to buy the 100 calls or whatever, but with the stock right here, and because you don't know what's going to happen in a reasonable risk reward wise, if I was just buying naked calls, I'd buy the 105 calls, and I would buy them in August with 36 days to go if that was my quote long call earnings play.
Got it. So you mentioned that because this is a binary event, you're sort of agnostic to the expiration date. But what if there wasn't a binary event on the horizon? What are your thoughts in terms of selecting expiration dates for a long call or put?
Well, in a lot of people for earnings, because it's binary, would choose July just because that same 105 call is a little bit cheaper. I don't think it's significantly cheaper. I'd rather have 30 days more for another, 60 cents or something. But some people prefer that because it's more, in some cases it's significantly cheaper. I usually live in that 30 to 60 day area. So that's where I would be on the long side and the short side. I view the option business as very complex and difficult in 7 days and under, and very fair in the 30 to 60 day range. And I view it as a different kind of strategy or a different kind of trade if you go in that 60 to 120 days. So I'm going to live in that 30 to 60 day range, even if it's not here's the earnings right here, July 16th. Our platform shows it. But I'm going to live in that 30 to 60 day range, and I'm going to live in the August area. If I'm just going naked long a call, or if I'm buying stock and selling a call, I'm going to be in that same area. I like my trades to be consistent. So I like to be, if I'm selling something, I like it to be that 30 delta. And if I'm buying something, I like it to be in that, or selling, I like it to be in that 30 to 60 day range with optimal around 45 days. It gives me enough time to tweak the position.
And generally speaking, what are your thoughts in terms of volatility environment to be long calls?
If you're ever going to be long calls, you want to be long calls. I feel like if you want to be long calls, now different with puts, but if you want to be long calls, the market, when the VIX is below 15, the market is up about 60% of the time. So if you want the odds in your favor and you want to pay the least amount of money for those calls, the best time to be long calls is when volatility is low, which it is now, and when when volatility is low and the VIX is low. And so because you have the highest chance for an up market and you have the cheapest price you're paying for the calls. So if you're going to be long calls, the perfect environment is right now, Tony.